Let's take a look at the factors that we should consider when choosing whether to buy or rent a property. I have an Excel sheet already made, so we can go ahead and take a look at the different variables that we should consider. First, we'll gather and input all the data and assumptions that we have. Then we'll see the difference in the amount of cash that you have at the end of the holding period. And lastly, we'll look at some non-monetary factors to consider in the buy versus rent decision. So let's get right into it. I have the template already made, as you can see. And we're going to go ahead and start by inputting the variables that we have. Let's assume that we're going to go ahead and buy a property for $225,000, and we're going to put 20% down payment. Now, the 20% down payment, if you put less than 20%, you would need to carry mortgage insurance, and that's just going to affect the model slightly. It's going to hurt the buy decision. But for simplicity, we're just going to use a 20% down payment, so we won't have to worry about that. The loan amount will just be the amount that you're borrowing from the bank. The interest rate, we're going to go ahead and give it a 4.25% interest rate. And then the loan will be 30 years, fixed mortgage. And the mortgage payment will be $885. That's just taking the information from above and using the payment function. Now, next we have the closing costs, and typically the closing costs will be around 2 to 5% of the sales price. So I went ahead and did 3% of the purchase price. The holding period, now this cell doesn't really do anything, but you can write how long you plan to hold the house for. Let's say if you buy the house, we are planning to holding the property for 10 years. Now, selling expenses, when you look to sell your property, you're going to have to pay commissions, fees, and all sorts of different charges, and that's typically around 6 to 10% around the sales price. And we'll go ahead and use 8.5% for the selling expenses. Next, we have insurance. And for insurance, if you buy the home, you're going to have to carry insurance on the property. The bank will require you to have insurance. And I went ahead and estimated 0.5% of the purchase price. Repairs and maintenance, as a homeowner, you're going to at one point replace the roof, maybe replace the AC, and different expenses and different repairs along the way. So I went ahead and gave that 1% of the purchase price. And property taxes, as a home buyer, you will be required to pay your property taxes every year. And I went ahead and gave it 1.3%. Again, these percentages could change for these expenses, but this is just an average. Now, for the renter, you're going to have an initial monthly rent, and we'll say that is $1,200. So the renter would pay $1,200 a month to live in the property. The property appreciation, typically the real estate increases with inflation, sometimes slightly higher, sometimes slightly lower, but it'll generally keep up with inflation. Let's go ahead and give it 2.5% for property appreciation, so the property growing in value. Next, the expense growth for repairs and insurance. Let's say those expenses each year go up 2%. And for rental growth rate, this is the rent that the renter pays. So in this case, if you rent the property, you'll pay $1,200. Let's say that rent increases by 2% each year just to match the repairs and maintenance and insurance of the buying scenario. For the investment opportunity, this is the money that the renter would take instead of putting it as a down payment to purchase the home. We'll put it into a different investment at around a 7% return on that money. Now, the marginal tax rate, this is used to calculate the tax benefit that you get as a homeowner by deducting your property taxes and your interest payments, but this really isn't that big of a factor anymore due to the change in the standard deduction, and I'll get to more on that in a second. But now that we have all the inputs and all the data placed inside the Excel sheet, we can go ahead and take a look at the option of buying the home. And when we're looking at the buying the home option, we're going to go ahead and take a look at the cash outflows and the cash inflows, and then lastly the amount of cash that we'll have at the end of the holding period versus renting. We start with year 0, which is today, and today what you'll have to pay is the down payment plus the closing costs. So that's the down payment, the purchase price times the down payment plus the closing costs. So today you'll pay over $51,000 to purchase the home. And then a year from now, this is year 1, a year from today, you'll have insurance and maintenance that you would have paid for the year, which is adding up the repairs and insurance. You'll have the property taxes, which is taken from here as well. And you'll also have the mortgage payment. And the mortgage payment is the monthly mortgage payment times 12. That's all the cash outflows that you'll have for year 1, and for years 2 through 10, we basically just take the prior year and grow it by the appropriate growth rate. So that gives you the total cash outflows that you'll have from buying the property. And next we have the cash inflows. Now for inflow, the only real inflow you have is just the tax benefit that is created by being a homeowner. But like I mentioned earlier, this tax benefit is not really that relevant anymore because the standard deduction is now $12,200 for 2019. So basically what that means, keeping it very simple, is if you own a home, you can deduct your property taxes and your interest paid on the property. Now, if you choose to deduct your property taxes and interest payments, you have to itemize. And if you itemize, you can't take the standard deduction. So basically, just to sum up the tax benefits, if your property taxes plus your interest payments, if those two together are not over $12,200, then you're not really getting a tax benefit, because then you just might as well take the standard deduction, which is given to you regardless if you are a homeowner or not. So if we had a bigger property tax and a bigger interest payment, these cells would be filled out, but since there's no tax benefit, they're all at 0. So in year 0, our cash outflow will be just the down payment, the $51,000, and then in year 1 through 10, we'll have the mortgage payment, the insurance, the repairs and maintenance, and all the other expenses. Now for the other category, we just have details that could just help us find calculations. For example, the interest payment just helps us find the tax benefit, because we need to know the interest that we paid to see if we have a tax benefit. And it also helps us find the principal payment, which is just the mortgage payment minus the interest. And quickly, just if you want to get the interest rate, this is the formula. Next, you have the house value. Now, at year 0, you buy the home, and assuming you buy it at a fair market price, you don't pay like a premium or a discount to the price, it's worth what you purchased it for. Now, this property is on average going to appreciate with inflation, and that's why we're taking the property and we're appreciating it by 2.5%, which is the property appreciation rate that we chose. So each year, from year 0 to year 10, a property should be appreciating at around 2.5%. Now the loan balance is the loan that we took to buy the property, and then each year that loan balance will be reduced by the principal payment. So how do you get the principal payment? Remember, that's the mortgage payment minus the interest. That's the portion that went towards the loan that reduces the loan balance. So if you look at the loan balance, each year it goes slightly lower and lower and lower. That's because we are making the mortgage payments. And the reason why we have the home value and the loan balance is just to get the equity in the property. Now, the equity in a property is just the home's value minus the loans attached to that property. So in this case, if you purchase a property and it's worth $225,000, but you owe $180,000, you only have $45,000 in equity, or $45,000 that you can take out if you were to sell the property. So this increases over time by two reasons. One, the property is going up in value, and two, your loan balance is being paid each year and it's decreasing. So with home value increasing and the loan balance decreasing, your equity grows every year, and then that gives us our cash at time of sell. So basically what this is taking is when you sell the property, you're going to essentially have the equity that you have in the property. But keep in mind, when you sell the property, you're going to pay selling expenses, and these expenses are taken into consideration when selling the property. So we would take the home's value and we would subtract it by the loan that we owe. That gives us the equity. But of that $91,000, we need to subtract the selling expenses, which is going to be 8.5% times the sell price, not the original purchase price, but the price at the time of sell. So effectively, you have $91,000 in equity, but after selling expenses at the end of year 5, which is this right here, you'll have $69,000. So if you hold the property for 10 years, you can have $120,000 at the time of sale. So that's basically the buying decision. Now let's go ahead and take a look at the rent decision, which is much simpler. So the first line in the rent decision is the rent expenses. And on year 0, which is today, in the buying scenario, you would put the down payment. But when you're renting, you don't need to put a down payment, but you'll usually have to pay a security deposit and maybe first and last month. What I did was I just took the monthly rent and I multiplied it by 2. So essentially saying you paid the last month's rent and you made a security deposit. So that will be the rent expense on year 0. And then on year 1 through year 10, it will be the rent expense right here, the $1,200 times 12. So that'll be your yearly rent expense. And then each year, the rent expense, as we said, is going to grow at 2%. The next line, we have the extra cash from not buying. Now, when you buy the property, you have a certain amount of cash outflow in the beginning, which in this case is the down payment. If you take the down payment minus what you have to put for your security deposit and last month, you get $49,000 that you're going to put in an investment portfolio. We move on to year 1, and in year 1, all you would have to have paid if you were a renter was $14,400. But if you were to have purchased the home, you would have had to have paid $16,000, almost $17,000. So that difference, which is $25,26, that is going to be reinvested into your portfolio. Okay, and we do that throughout the 10 years of renting. That's what the investment portfolio line takes a look at, which basically takes the prior year, it grows it at our growth rate, which is the investment opportunity, in this case 7%, and then it just adds at the end the difference. And that continues to go on for the years as you're a renter. And as you can see, by year 5, if you have this property and this renting scenario, you'll see that you'll be better off renting this property than by purchasing the property. You'll have more money at the end of 5 years. And if you go to the 10th year mark, it's the same thing. You have more money as a renter than as a buyer. Now, renting isn't always the best option. Sometimes the better option is to buy. And we can see that if the rent instead of $1,200 was just $200 more, you would think that's not that big of an increase. Well, it is, because then in year 5, with the rent at $1,400, just $200 more, you can see that you're winning if you were to purchase the property. You would have $69,000 at the end of 5 years compared to $67,000 if you were a renter. And that disparity, or that the difference in buying and selling, only grows in the favor of buying. So that's another thing to consider. The longer you hold the property, the more likely that the buying scenario would be best for you. And we can show an example of that by putting the monthly rent at $1,300. which is just $100 more from the first example. By year 5, we see that you're still winning as a renter, 74 compared to 69 at the end of 5 years. But if you take a look at the 10th year, the buyer is now the person winning compared to the renter. So this is a decision that most people don't run a model like this or take it into consideration. A lot of people are either fixed on, I'm going to either buy or I'm going to rent, and they don't look at the different variables and the amount of money that you can save if you just take the time to run the numbers and see which scenario is best for you, whether buying or renting. Now, I just want to take a look at some final non-monetary considerations. So this does not include money. And a few things to consider is, if you choose to rent, you need to be disciplined and you need to invest the down payment that you would have originally put for the home, and you need to invest every single year the difference between buying and renting. If you don't, you'll be significantly behind, no doubt about it. And then that's a kind of a con to renting, that you got to be disciplined. A pro to buying is that you don't need to worry about a landlord. You can remodel the home to your pleasing, and it helps you invest without having to actually do investing. And to put that in easier terms, if you're buying a home, you're forced to invest in the property with the mortgage payment. But if you're renting, you need to put that money on your own to work for you. So that's pretty much the buy versus rent decision. I hope the video helped, and the video can help people in the future make a smarter decision when it comes to buying or renting their first property. Thanks for watching.